The closing bell rang 15 minutes ago, and the scoreboard is officially locked for Monday, June 1st, 2026. We are bypassing the fluff and going straight to the data for today's deep dive. Looking at the closing print, the S&P 500 closed up 0.3% to finish at 7,599.96.
Right, which is its 23rd record close of the year.
Exactly. And the Nasdaq Composite gained 0.4%, finishing at a record 27,086.81. The Dow ticked up 0.1% to end at a record 51,078.88. Fresh records entirely across the board.
But the real risk here is taking those headline numbers at face value. Because if you parse the internals, today was not a breakout. It was the exact definition of chop.
I mean, if all three major indices are sitting at all-time highs, why are all of our institutional strategy briefs uniformly calling today's market a choppy mess?
Well, because the narrative of a massive breakout that, you're seeing on financial television right now is fundamentally false. Fewer than 39% of the stocks in the S&P 500 actually finished in the green today.
Wait, 39%?
Under 39%. That means a staggering 61% of the index was in the red. They were actively bleeding capital today, while the broader market indices were somehow being dragged up to historic records.
So the market right now looks like a luxury high-rise built on a sinkhole. I mean, the penthouse, those top 10 megacaps looks absolutely spectacular, but the foundation holding it all up is actively crumbling beneath them.
Yeah, it's the ultimate split-screen reality. Just 10 stocks control nearly half of the S&P 500's total market value right now. We are looking at a 40-year high for market concentration.
Which is just wild.
It is. So when the headline index gains ground, it has become a terrible indicator of actual economic health. The real money isn't buying the whole economy anymore. They are aggressively crowding into a tiny, hyper-concentrated lifeboat.
And if you're actively managing a portfolio, that is an incredibly dangerous tape to navigate.
Yeah.
So my question for you is, why is the broader market struggling so much? What is chasing everyone into that specific lifeboat?
It comes directly back to the macro headwinds that completely disrupted the open this morning.
Right, the geopolitical trigger over the weekend.
Exactly. Renewed fighting threatened that fragile U.S.-Iran ceasefire. That sent Brent crude surging over 4% intraday, peaking at $94.98 a barrel.
And immediately you saw the ripple effects across the tape. Because an oil shock is basically a tax on the consumer, right?
A tax on the consumer and a total margin killer for businesses. Transport stocks got crushed right out of the gate. United Airlines was down 2.7%, specifically on jet fuel margin fears.
Traditional financials took a hit, too. Visa closed down 1%.
Yeah, because when Brent crude flirts with $95, the bond market instantly prices in sticky inflation. And that means interest rates stay higher for much longer.
Which brings us to the volatility data. Because the panic happening in the foundational layers of the market, it's showing up exactly where you'd expect it to. Usually when the market hits record highs, complacency sets in and volatility gets crushed.
Right, the shorts get squeezed out.
Exactly. But today, the SIBO Volatility Index, the VIX, actually rose 3.3% to close at 15.83. It even ticked over 16 late in the session. A rising S&P 500 paired with a rising VIX. You do not see that every day.
You really don't. And it is one of the most glaring warning signs in market mechanics. A rising S&P paired with a rising VIX means institutional players are quietly buying downside protection.
They're hedging.
They're aggressively hedging. They're absolutely terrified of a sudden geopolitical shock, like a total irreversible collapse of that ceasefire in the Middle East. Yet, by their mandates, they are forced to chase this upward market momentum.
So no portfolio manager at these institutional desks is truly complacent at 7,600.
Not at all. They're terrified of underperforming their benchmark by missing the upside, but they are buying put options by the truckload just in case the floor falls out.
It's the definition of a forced buyer.
Yeah.
But the real risk here is how those macro pressures hit the most vulnerable, rate-sensitive sectors. Just look at the small caps today.
The Russell 2000.
Yeah, it opened deep in the red, down 1.3% early in the session, purely driven by those inflation fears from the oil spike.
Yeah.
Small caps carry heavy debt loads. I mean, they cannot survive indefinitely at these interest rates.
But then we saw a massive key reversal.
Right. The Russell aggressively recovered throughout the afternoon to close down only 0.5% at 2,905.76.
Which is a crucial data point for anyone trading tomorrow's open. It tells us that there is still strong systemic institutional support below the surface. The real money bought that morning dip.
So they aren't letting the broader market completely break.
No, they are facilitating a controlled rotation. They're reallocating capital away from the most rate-sensitive names, but they're stepping in at key support levels to prevent a cascading sell-off.
Okay, so let's look at the logic here. If you were managing a portfolio today, you're looking at a 10-year Treasury yield stubbornly holding at 4.45%. You're looking at Brent crude threading $95. The broader market is terrified. So what exactly forced the S&P and the NASDAQ into the green?
The answer isn't in Washington, and it isn't in the Middle East. It's in Taiwan.
Right, Computex in Taipei.
Exactly. Nvidia CEO Jensen Huang unveiled the next-generation Vera Rubin AI chip platform alongside the new RTX Spark superchip for PCs.
And the hardware boom that followed across the tape was just monumental. Nvidia surged 6.3% to close at $224.35.
And it wasn't just them. The entire hardware ecosystem caught a massive bid today. Dell Technologies jumped 10.7% to $465.96.
And Micron.
Yeah, Micron gained 6% to $1,035.50 after catching a huge price target upgrade to $1,100 from the street.
The pushback here from a traditional investor perspective is that the math doesn't seem to add up.
How so?
Well, traditional market logic says that high treasury yields act like gravity on high multiple tech stocks. A 4.45% risk-free rate makes the future cash flows of growth tech companies mathematically less valuable, in a discounted cash flow model.
Right.
So with the 10-year sitting at 4.45%, why is this specific segment of the tech sector suddenly completely ignoring financial gravity?
Because the institutions managing trillions of dollars are completely rewriting their definition of safety. They are treating pure-play AI growth as entirely recession-proof.
Recession-proof, that's a bold claim for hardware.
It is, but they don't view this as a speculative software bubble. They view this as a generational infrastructure build-out. They believe this capital expenditure cycle, buying GPUs, building data centers, will happen regardless of whether the broader consumer economy slows down or not.
So they're buying AI hardware the same way they used to buy railroads or utility grids.
Exactly. And to fund those massive purchases, we saw a violent rotation today. I mean, look at the laggards. Utilities, which are your classic defensive rate-sensitive dividend proxies, plunged 3.05% today.
Wow, 3% drop on utilities in one session.
Yeah, investors dumped them wholesale to chase AI hardware and enterprise software giants.
And we really need to group these moves conceptually to understand what the big money is doing. Because it wasn't just a random list of tech stocks going up. The hardware layer, Nvidia, Dell, Micron, is pulling up the software layer.
Absolutely. The software breakout was huge today. Companies like ServiceNow, which skyrocketed 10%, or IBM, which also surged 10%.
Oracle jumped 6% too.
Right, because these are the companies that possess the enterprise pricing power to actually monetize the AI hardware. They are the ones selling the final product to the Fortune 500.
That's the exact ecosystem the money is flowing into.
And it's a huge shift. Enterprise software had actually been penalized heavily earlier this year on fears that AI would disrupt them. But today was a complete structural trend reversal.
The big money is actively rotating out of traditional low-growth safety and moving into tech companies that can definitively prove their AI infrastructure is generating contracted revenue.
Meanwhile, the legacy players who are caught offside in this paradigm shift are getting punished severely.
Which perfectly explains the bloodbath in legacy chips today.
Exactly. Look at traditional PC semiconductor incumbents. Qualcomm dropped 8.8% today.
Ouch.
Yeah, and that wasn't a macro sell-off. That was purely on fears of intense direct competition from Nvidia's new RTX Spark architecture. The market is basically cannibalizing the old tech guard to feed the new AI ecosystem.
Okay, so we know the what. We know the AI ecosystem single-handedly carried the indices while utilities bled out. But how did the big money actually trade this session? Because if we're going to navigate tomorrow's open, understanding the volume confirmation into the close is absolutely crucial.
Right.
Did the real money actually buy this close, or was this just algorithmic noise?
The answer is a definitive yes. We saw major volume confirmation today. This was not retail traders pushing up meme stocks on light summer volume.
Give me the numbers.
Trading volume on the NYSE closed 20% above its 30-day average. The Nasdaq Q volume landed 9% above its one-month average.
So this wasn't just some sleepy Monday drift.
Not at all. This was high-conviction institutional flow. Asset managers actively re-engaged to kick off the month of June. They're treating these geopolitical pullbacks, like the morning oil spike, as liquidity windows to aggressively load up on secular AI growth.
But there was a very clear shift in the afternoon that we need to unpack. The morning was deeply defensive, the small caps were bleeding out, and oil was surging. Then, suddenly, large desks start sweeping the tape in the final hour, lifting the indices to those fresh records.
Right, so you have to ask, what exactly gave those large desks the green light to buy at the close? They didn't just randomly decide to bid up the market at 3 p.m.
It was the Trump headline.
Exactly. It came down to a sudden cooling of that specific macro pressure. Late in the day, President Trump made comments to the press suggesting that diplomatic talks between the U.S. and Iran were progressing rapidly toward a resolution.
And whether those talks actually finalize or not almost doesn't matter for the intraday tape, does it?
Nope. The market algorithms reacted instantly to the headline. It diffused the morning oil spike immediately. Brent crude retraced from almost $95 back down to $92 a barrel.
And the moment oil cooled off, Treasury yields stopped their upward climb.
Which gave institutional desks the all-clear. The pressure valve released, and they aggressively bid megacap-tech right into the closing print.
And that institutional hunger did not stop when the closing bell rang. Let's talk about the post-market fireworks, because these are your massive day two plays to watch for tomorrow's open. The first one is Hewlett Packard Enterprise, ticker HPE.
Huge day for them.
Yeah, during regular hours, it was already trading incredibly well. It closed up 9.35% at $47.06 on 75.6 million shares, which, by the way, is 287% above its average daily volume.
Massive volume confirmation there.
And then the after-hours earnings print hit, and the stock rocketed an additional 30%.
And the underlying mechanics in that HPE earnings report are exactly why institutions are currently calling AI recession-proof. HPE reported Q2 earnings per share of 79 cents.
And the street was only expecting 53 cents.
Right. Revenue came in at $10.68 billion, handily beating the $9.76 billion estimate. But the backward-looking numbers aren't what caused a 30% after-hours explosion.
It's always the guidance.
Always. The metric that broke the tape was the forward outlook. Management cited an AI backlog and order book that has nearly doubled year over year.
So if you're a trader looking at a 30% after-hours move on a legacy hardware name like HPE, your instinct might be to fade it. Isn't the easy money already made? Why is the strategy brief warning us not to short this gap up tomorrow morning?
Because you do not step in front of a structural asset reallocation. When a company reveals that their AI order book has doubled, institutional models have to be instantly rewritten.
Right, because they are underweight.
Exactly. Portfolio managers who are entirely underallocated to HPE are going to be forced to buy the stock at the open just to match their benchmark weightings. That creates a massive vacuum of buy orders. If you try to short that, you are stepping in front of a freight train of forced institutional buying.
So it's a classic post-earnings gap-and-go setup. The playbook says you look for an opening range breakout or a shallow pullback to key after-hours support levels, and you go long, targeting a continuation of this AI hardware momentum.
Precisely.
And HPE wasn't the only one dropping massive numbers and forcing capital reallocation today. Science Applications International Core, ticker SAIC, also went parabolic.
Yeah, SAIC was a flawless structural breakout. It surged 17.87% during the regular session to close at a new 52-week high of $122.82.
And their earnings were just as strong.
They reported a massive Q1 earnings beat, pulling in EPS of $3.23, absolutely demolishing the $2.26 street estimate. And that was on $1.91 billion in revenue. Furthermore, and this is the key to the momentum, management immediately raised its fiscal year 2027 adjusted EPS outlook.
So why is raising the 2027 outlook so critical for the price action tomorrow?
Because it proves to the market that the revenue isn't just a one-off anomaly. When management commits to higher earnings 3 years out, it tells institutional desks that the pipeline is secured through long-term contracts.
Right.
So as a day two momentum play, high-volume structural breakouts like SAC attract heavy institutional asset reallocation that doesn't just end after one session. It takes days for large funds to build their positions.
You watch for a minor pullback toward that previous breakout trigger around $121. If buyers defend that level in the morning dip, you go long for the continuation. Got it. But as we transition from these individual massive stock moves to the broader index contextualization, we need to map out the exact levels for the S&P 500. because trading HPE in isolation is one thing, but how do we trade the broader index tomorrow?
The absolute line in the sand right now is 7,500 on the S&P 500. This is what we call the gamma wall.
Okay, hold on. For anyone who isn't actively managing a derivatives book right now, what does gamma wall actually mean for the price action at tomorrow's open? Why does 7,500 matter so much?
Think of it as the center of gravity for market makers. A gamma wall is the strike price where the largest amount of options contracts are currently sitting.
Right.
Because market makers, the big banks providing liquidity, have to constantly buy and sell the underlying stocks to hedge their options exposure, they are structurally forced to buy the market when it dips towards 7,500 and sell the market when it rallies too far above it.
So as long as the index stays near this wall, it mathematically dampens volatility.
Exactly. As long as we hold 7,500, the market makers are actively defending the floor and the bulls remain in control.
But what if it breaks?
If the macro headlines fail, say, if oil spikes back toward $95 tomorrow morning, or the ceasefire talks officially collapse and we break below 7,500, that dealer support vanishes. The next immediate support level you need to watch is 7,340, which was the May 19th swing low.
And below that?
Below that, key structural support sits at 7,300. On the flip side, the immediate upside target ceiling is 7,600. Today, we closed at 7,599.96, basically kissing that ceiling.
So a clean break above 7,600 tomorrow morning opens the door for market makers to actively buy the index to hedge their upside exposure, pushing the index towards 7,700.
That's the chasing delta dynamic, yes.
But looking at the historical data in the strategy briefs, the probabilities of a massive runaway trend tomorrow are actually somewhat muted, aren't they?
They are, and this is crucial for managing your size tomorrow, because Monday was a choppy, news-driven grind and not a clean, high-conviction trend day across the entirety of the market. Statistical follow-through is historically low.
Like how low?
In a positively hedged environment like we have near this gamma wall, a close like today's only carries a 53 to 55% probability of trend continuation the following morning.
So essentially a coin flip.
Pretty much. So the playbook advises you to expect range-bound chop at Tuesday's open as the broader market slowly digests these massive post-market tech earnings.
And you cannot lose sight of the macro calendar.
Yeah.
If you're trading this AI momentum, you have to be aware of the incoming economic data. This hyper-narrow, all-is-well narrative in the tech sector is going to be stress-tested immediately by the real economy.
Right, the data drops.
Tomorrow morning, we get the ISM Manufacturing PMI report, and looming at the end of the week is Friday's non-farm payrolls report.
Which is huge.
If real economy activity shows that inflation is reaccelerating or that the consumer is completely tapped out, these astronomical tech valuations are going to face a reality check.
Yeah.
And that gamma wall at 7,500 is going to be tested very quickly.
So keep your dry powder close. The market's engine is running on only 1 or 2 cylinders right now. If the tech hardware trade stalls for even a moment, there is absolutely no safety net underneath. The remaining 61% of the market is already bleeding. You have to stay nimble.
So to sum it all up, you need to understand that we are operating in a ruthless, split-screen reality right now. On one side, a handful of AI titans, Nvidia, Dell, and now HPE, are single-handedly dragging the major indices to historic records on massive institutional volume.
And on the exact same screen, that green index level is an illusion masking a struggling foundation.
Exactly. 61% of stocks are in the red. Small caps are fighting for their lives against 4.45% yields.
Well,
And institutional players are quietly loading up on VIX downside protection, absolutely terrified of oil shocks.
it is the ultimate tug of war. The surging, price-insensitive demand for AI infrastructure is fighting head-to-head against crude oil volatility and the realities of a strained consumer.
Which leaves you with this final thought to mull over as you prepare your screens for tomorrow's opening bell. If institutional money is treating AI infrastructure as the new recession-proof safe haven, blindly rotating out of traditional utilities to chase Nvidia and Oracle at all-time highs, what happens if the upcoming economic data shows the real economy diverging so far from the stock market that even the top 10 megacaps can no longer carry the weight?
That is the multi-trillion-dollar question.
Are we watching a permanent paradigm shift in what defines a defensive stock, or is this just the narrowest, most fragile bubble in financial history? Trade the levels, manage your size, and we will see you back here at the opening bell.